welcome to everybody on this budget session. I guess every budget has, always a question in our mind saying that, okay, what's in it for us? Did it achieve the objectives? Is it something that will help us, do well on our portfolios, etc.? Okay, so those are some of the questions that we try to sort of answer today. So the first part of my presentation is on how does it impact my personal finances. Okay, so and I thought one of the best ways to start it off is with a poll. I think before I color your points of view, okay, maybe if we can just run the poll and talk about, as per you, what is the impact of the budget on your personal finances? Yes, so I guess there's quite a bit of people, polling in. So thank you for that. We just give maybe a few seconds and we'll sort of, end the poll. Yeah. So it's interesting. Okay, most people feel it's neutral. Okay, and negative, just 5% of them feel it has a negative impact, and the second largest is, set of people saying believe that it's a positive impact. So that's sort of an interesting, perspective. So I think from the communication standpoint, I guess our finance minister has done a reasonably good job out there. Okay, so yeah, so sorry, I think what is coming again. Okay. So basically, if we look at one of the key things that this budget has tried to do is trying to simplify personal finance. And I keep telling people as well, one is yes, that can I make some additional money? Will I save some tax, etc. But it's also to do about how you can make life simple for us, right? And I think in the last few years, unfortunately, things have become a lot more complex on our income tax filing. I think for all of us must be experiencing. So in some form, this is a bit of an initiative to address that. Okay, so and what is the government trying to do? What's the finance minister trying to do? The point is trying to push towards the new tax regime. Okay, so a couple of years back, they added a new tax regime, which was a simplified one, and it took away all the deductions, but it also lowered the tax rate. Right. So this year has continued to tweak around the tax slabs, especially for the new tax regime. So interestingly, all the changes have happened, all the increase in slabs have happened only for the new tax regime. So I think that's sort of the message to move towards it, and over a period I won't be surprised if that's the only thing that is left. And I think that's also a good initiative and objective, so that life becomes simpler for all the investors. Now with all of it, right, the question that each of us may be asking, okay, is now does it benefit me? Okay, does it still make sense to use the old tax regime or moving to the new tax regime? And that's something we will cover in the next couple of slides. Now, just to give a bit of a perspective there, on the right hand side, the graph shows that what is the slabs that they have changed. And so right now 3 to 6 lakh is something like 5%, and 6 to 9 is 10. Okay, so you have a pretty low tax slabs at the beginning, which is good. And also, if you see as you go forward, the 15% slab now is 9 to 12 lakhs, and 20 is 12 to 15, and only above 15 lakhs, one has the 30% slab. Now that's reasonably, wide, to a band to say that, okay, above 15 lakhs, you end up paying 30%. And I think that's a sort of a reasonably good measure. Okay, but many of us will find that it still may not give you, too much of benefit out there, when we go and see versus the deductions that you can claim. Now, the point to keep in mind is when you use the new income tax regime, you do not get the benefit of the deductions. Okay, so of course, this time they added a standard deduction for the new tax regime as well for incomes exceeding 15.5 lakhs. So that is something which is, I think, a good thing that they've done. Okay, to make them sort of come more closer. The other benefit, that clear benefit here for people who are above 5 crores, they had a crazy surcharge of 37%. Now that is reduced to 25. Of course, the only issue is that it's on the new tax regime again. So they have not made that change for the old tax regime. Increasing the tax exemption to 25 lakhs for leave encashment is the other feature that I think is a good one. Okay, and it is for non-government salaried employees. So this is definitely if you're retiring, etc., then this is a large enough limit, and I think this is definitely something which will help you. Now, the big question, right? Should you choose old or new tax regime? Okay, and basically you use, we've captured for different salary levels, and we also said what is the break-even point. Now, the thing is, how much of deductions that you use, right? So if for up to 10 lakhs, if you have deductions of more than 3 lakhs, then, the old tax regime is better. Okay. So that is something. So if somebody doesn't have a home loan, etc., then yes, the new tax regime is definitely a better thing to do. So we've captured it like similarly for 12.5 lakhs. Okay, you should have claimed at least 3.62 lakhs of deductions. Okay, now what are these deductions? It is, all the home loans, 2 lakhs, Section 80C, 1.5 lakhs. You have another 50,000 rupees for NPS. Then you have ATD, which can also sort of go up to 50,000 rupees. So those are some of the things which will not be available in the new tax regime. So that's something that, so if you are able to take deductions above 3.62 lakhs, then again, the old tax regime is better thing to do. Similarly, if it's above 15 lakhs, it'll be broadly, the same if you claim all deductions. Okay, and we also spoke of the super rich, where say it's above 5 crores. If you remember, there was a surcharge drop from 37 to 25%. Okay, and so for them, clearly, the new tax regime is a definite one to go in for. So that's the sort of summary there. So just to simplify it for you, I think if you have a home loan, right, then the old tax regime may be a better thing to do. Okay, but if you have, if you don't have a home loan, then definitely I think it's something that one can go in for the new tax regime out there. Okay, so that's, I would summarize it that way. So for most of us, if you have home loans, etc., this budget has not helped. But I would still believe the majority, including some of the high net worth individuals and people with higher income, have completed their home loans or have a small home loan, then definitely the new tax regime is something that will make sense for you. The other thing that the budget has done is to incentivize savings. Okay, and they've tried to have a slightly social cost. Okay, now this is not surprising in terms of the benefits coming in, mainly because the next year is an election year, and mostly there will be no budget per se before elections, and which basically means that whatever benefits that the government wants to give in the election year has to happen now. So you'll see a bit of a social color to it, and also possibly that's the reason why the tax slabs also have been sort of tweaked around in the new tax regime, so that a large part of the population which is sort of at lower tax slabs, will definitely benefit from the new tax regime, right? So that's I guess the objective is to try and reach out as many people as possible in an election year. And the other good thing is that for senior citizens, some of these savings schemes, etc., have the senior citizen savings schemes have been increased to 30 lakhs from 15 lakhs. Okay, the post office MIS scheme was 4.5 lakhs made to 9 lakhs. Okay, so some of these are, and they also have a Mahila Samman savings certificate up to 2 lakhs at a particular rate of interest. Okay, so that is those are some of the plus points. So they've tried to look at senior citizens, they've tried to look at the low income levels, they also try to look at women and sort of benefit them, especially when they are sort of suffering from the lower interest rates that you have right now. The negative things that sort of have come in the budget are there at the bottom. One is the capital exemption. Of course, this is only for, let's say, if you sold your company and or something like that, and you're looking to buy a house of above 10 crores, right? Then you cannot avail the exemption, beyond the 10 crores. So that is something which is will impact for some of the higher, really high slabs there. And normally this happens when you either sold a large property or you've sold your company, right? So those are the cases that they've tried to plug so that there's no large tax outflow out there. The other is about REITs and InvITs. If you have REITs and InvITs, which is real estate investment trust and infrastructure, vehicles that you have for income bearing vehicles, so then you would actually end up having a negative impact, because earlier it was broken up between principal repayment and interest. Now whatever the cash flow distributed, including as redemption of debt, is now taxable. Okay, so they're basically saying that InvIT basically what you're showing as principal repayment actually need not be categorized that way, because the whole continue to make returns on the overall. So they're saying that now the whole thing will be taxable. I guess not too many of us are using REITs, so this may not have such a large impact. Okay. The other big one, which is I am hoping there will be a change, is the LRS, which is the liberalized remittance scheme. Okay, the tax collection at source earlier was 5%, and this has been increased to 20%. Okay, and that was the 20% sort of without limit. Of course, they have excluded education and medical. Okay, so they try to look at the social side, is not a problem, but I think this is a big sort of negative. So when you're transferring money outside and making global investments, I guess quite a bit has happened in the last few years, as NASDAQ and some of the other markets have done reasonably well. Okay, so that's something that will be a big negative. Now, what one keeps in mind is it's not that it's a tax; it's only a tax collection. Okay, so what will happen is this tax collection will get added into your TDS type of whatever you accumulated there, and it will be set off against your tax for the year. So effectively, it's a cash flow issue. It's not a tax issue, that you are paying this money and you can adjust it only against taxes, or you claim a refund, if you're not able to adjust against your income, rest of your income taxes. So the other part of it is in terms of TDS on EPF withdrawal. Okay, that is something. If you don't have a PAN number, then it was at 30%. Now they sort of made it 20%. And NCDs, listed NCDs, were exempt from TDS. Now the government wants to have the TDS because they want to track the interest that is sort of coming in from those people. The impact on life insurance and MLDs, this is the other place which has had a large impact. And especially in recent years, there were some good guaranteed return insurance plans which HNIs had started using. In fact, that's a narrative also in the budget speech, that a lot of HNIs are using this, and it's a good benefit to them. So they want to curtail the value of it. So this is now curtailed to 5 lakhs, which means that earlier ULIPs had a bit of a taxation, okay, of the end proceeds. Now, traditional policies also will be subject to tax if your premium on a cumulative basis across all policies goes up beyond 5 lakhs. Okay, so that's a big negative. Okay, and so I mean, if somebody is liking wanting to have a guaranteed monthly income for retirement, then this is something to consider before the end of March, because from April 1st, this benefit will not be there. And it's also the way it's worded and tweaked, etc. It has a reasonable impact, because the computation here, for example, shows 6.65 pre-budget going down to 6.38%. So there is a some bit of impact out there. The other one is market-linked debentures, or MLDs. Okay, so MLDs basically now have been, you could get a benefit there for listed MLDs. Now that benefit is somewhere, it's been taken out. Okay, so it's added to income and it's treated like. So it will be basically, if you see here, the income from market-linked debentures will be taxed at short-term capital gains, okay, at the applicable rate, which is the marginal tax rate. Basically, just added into income irrespective of the period of holding. So what they've done it's almost like interest, even though they've captured it under capital gains. They've captured it under capital gains, which is short-term, and for debt, so which is just the same. It's just a complicated way of making it. Okay, so the second part of it is how does it impact my portfolio? How is the portfolio impacts? And portfolio impacts are slightly maybe wider, based on how the economy does and what are the benefits. Is it a growth-oriented budget and stuff like that? Which brings me back to the next poll. Okay, what is for you the impact of the budget on the economy? Right. So Sanjay, can you run the poll? Okay, so again, some very good participation from people on the poll. Okay, we'll give a few more seconds. Yeah, I think almost 70 people have polled out there. Okay, and this is a thumping majority. 70% say it is positive, 16% feel it's negative, and 14% feel it is neutral. So that is something which is interesting, that everybody feels that from the impact on the economy and let's say our portfolios, etc., that the budget is going to have a positive impact. Yes, so we'll move to the next. Okay, so key takeaways of the budget as per me, one is the budget is continuing to focus on macroeconomic stability. What that means is that they are ensuring that they are not indiscreet in their spending, and they are wanting to lower the fiscal deficit towards 4.5%. Okay, so that is something which is a positive, and it's important, because if one is not being very disciplined on the fiscal side of the country, and ensuring that the deficits are not under control, you'll see high inflation, and that's sort of going to come back, and they are long-term negative impact. So I think that's a good one. So if you're looking at a long-term budget, not just giving freebies, and in an election year, I think it's a good positive step forward out there. So that's the first thing. The second is about so the budget has been trying to bring in credibility and its intent, and so by making some of these simplifications and in various other ways, where they want to encourage certain aspects, they sort of are increasing the benefits to that particular sector, etc. So that is, one important part. The other is, I think it's been a little bit of they've looked at a slightly social one. A number of measures have been added, across various developmental schemes. Okay, and so that is something which is there. Better expenditure quality. Okay, and like I said, it's important in a year which is before elections. Okay, lower subsidy is something which is an important thing which ensures long-term stability. Okay, deficit is easier to fund. Okay, but there are debt to GDP is almost like 83%, and it is high. So interest is continuing to sort of eat into the spending there, and that's people who have had a negative view on the budget. Some of them have been concerned about the increasing interest which is being serviced. So what is their point is there's a lot of money which is going to wasteful things, and they're not enough is being done for developmental. But I think some of these are things in perspective, and it's built up over the many years in the past. So that's something which I think can only be done in a phased manner, because if you're too tight on it, okay, then you may find that it will impact growth and will have other negative implications. The other part of the budget is about, and I think this is what makes it a growth budget. There's a strong capex of 10 lakh crores, sort of, which has come in with this budget, and almost like 2.4 lakh crores is for the railways. So strong capex, especially on the infrastructure side, and this I think a very good thing to do. I think the government needs to focus on infrastructure, build it up, spend on it, because when you spend on infrastructure, then there's so many ancillary industries which will also benefit, and that creates growth in the economy. So that's something which I think is one of the best ways of sort of going about it, and one is happy on that. Like I mentioned, on the developmental side, there are a lot of drinking water and toilets and LPG. There's a lot of schemes which have come in there. Insurance cover. Okay, so I mean, Jan Bank accounts, etc. All of those are getting sort of priority. COVID vaccinations also is something. So there are also transfers to farmers and the PMS Kisan Yojana that they have. Okay, so the good part is urban unemployment sort of is coming down. Of course, I don't think we have some great measures of unemployment, etc. But definitely, whatever the official one, there is sort of improvement out there. Okay, growth also remains sort of resilient in the economy. The other is, I think our fundamentals are sort of slowly improving. The fiscal deficit in COVID time, post-COVID time, had gone up almost to 9.18%. Okay, now that is on a declining trend, and the estimate for the year also continues to sort of come down there. Okay, so capex, like I mentioned, the top right-hand corner graph from FY16 from 2.5 lakh crores to 23, 7.3 lakh to 10 lakh crores is what is the budget estimate for the next year. So that's a very, very good and healthy growth out there, and that's been the way of the government to sort of spur growth for the economy. And the good part for all of us is, CPI, the right bottom corner, okay, WPI and CPI converging, okay. And so earlier we used to find that CPI used to be far, far higher than the wholesale price index. CPI is the consumer price index, okay. And so consumer inflation had been much higher. Over the recent years, it's actually been the opposite. Okay, but right now they are sort of converged, and I think that's a long-term stable sort of way to do it. Asset quality and NPS also are sort of improving for the economy, so we are sort of in a much better place. Okay, and forex reserves also cover a clear sort of 9 months, and that has been flattish from the recent past, but it's not eroded, too much out there, and we've come back from the lower levels that we saw around COVID times. The other points that we sort of keep in mind is allocation to major schemes. Okay, so from here I'll go on a little faster because these are things which maybe we will sort of incorporate in our portfolios and look at what are the impacts that various places there. But one couple of sectors which I think are going to benefit strongly is the building material, because that has been having something. You have something for the vehicles, pharmaceutical. Okay, so that is something which is there, and there's a little bit for the Northeast infrastructure development. Interestingly, defense has got a lower allocation this time, growth. Okay, you can find that, and this is where we are saying that the government is also intent is there. It's showing intent in action. Okay, so it's trying to spend more on railways, infrastructure, agriculture, etc. And those are the places that they're trying to move forward towards, and also brought in rural development, a new budget out there. So I think that's a good and positive one, because one believes that the government needs to look at infrastructure, needs to look at the social aspects, and supporting people who are unable to manage their own finances. Okay, so the simplification, like I mentioned, is continuous even on the indirect taxes. So there are a lot of changes which have happened, and again, you will see that each of them have certain benefits there, whether it's mobility, okay, and the chemical industry, exports, okay, augmenting MSMEs, and in fact, that's also been a little bit of a focus of the government, is the MSME side, which is an important one. Sector impacts, again, we have a detailed note which maybe we can share with each of the persons who sort of attended here, but which are the positive sectors: banking, housing, automobiles, etc., infrastructure, consumer and capital goods. They are all having sort of positive benefits of it, and the details of each of the schemes which the government has sort of brought in there. So there's quite a bit of small tweaks and benefits and focus areas that have happened, while keeping in mind the overall long-term objective. Okay. Sectors with a neutral impact have been like healthcare, telecom, technology, and chemicals. And sectors of negative impact actually is insurance. Insurance, we spoke of the traditional insurance policies above 5 lakhs getting impacted, and that was a big growth area for some companies, like especially HDFC Life. Okay, so that is will have a bit of a negative impact on them. Okay, so what are the factors dominating 2023? Yes, it's a pre-election year. Okay, you have rebound in global growth. There's some bit of from the lows, we are finding that some movement is again happening again. One needs to see whether that is sort of sustainable. If you see, the government capex has been very, very strong, and for the economy, the good part is the revival of the credit cycle. Okay, so what had happened in the previous decade, because of the increase in non-performing assets, etc., you had the credit cycle, which was very poor, and so industry was not getting the loans that it wanted, whatever the interest rates were, because the banks had become very conservative, keeping in mind the non-performing assets that they were seeing. The low inflation environment is the other good thing for us, okay, and that's a big positive. Of course, the issue that happens with low inflation environment is that the interest rates also are lower. Okay, so if you are having a lot of fixed deposits, then or debt-oriented instruments, then that's going to sort of impact you. If you have a low inflation. Yes, rural consumption, which was a pain point. I mean, for a long period, rural India did much better than all the cities, etc. But today it has been struggling, and part of it had to do with the inflation coming down in agricultural commodities. Okay, now what has benefited us, unfortunately, has also impacted the farmers, and the growth that they were seeing. Now that's a balancing act. Now the good part is rural consumption also is slowly beginning to pick up, and the earlier very, very low inflation and possibly in some cases negative inflation that one saw in some of the agricultural commodities is sort of behind us, and things have become much more stable. So rural consumption is picking up, which is also good for the economy. The improvement in the global supply chain, yes, there have been a lot of Make in India and other initiatives and benefits that the government has given for exporters, and so that is something which the performance linked incentives is what they brought in for exporters, and that is slowly we are seeing the benefits of it, and in the long term we think that it will only get sort of better. So I think a few things that have gone well is the whole branding for the Make in India campaign that happened. I think was reasonably good. The measures that the government also took towards simplification. Of course, people still feel that much more to go, but simplification has been a good part. And the PLI and other incentives that are coming in sort of now, you're finding that even MNCs are looking at India, especially at a point when they're looking to have at least one more country or one more location for their facilities, their global facilities apart from China. So I think it has been very, very timely, and all of them have sort of come together, and one believes that this is going to be a big growth engine for the Indian economy. And one thinks that in this phase and in this decade, you'll probably see some of the core sectors, the manufacturing, etc., actually possibly will do far better than some of the services oriented and exports like technology and stuff like that, which have done very well for us in the long term. Now, this is also, of course, the technology is seeing some bit of headwinds from the global side and the customers and tightening global environment. Okay, so it may not have too much to do with the local side. Okay, but yes, the good part is while that sort of slows down, you find the core sectors of the economy sort of do well, and that's good. Okay, so the other is market share gained by quality companies is something which is also sort of happening. So I thought this time market view, I'll capture more in charts, okay, and have it very brief, because I think I felt that that's a question that will be coming from many of us. So in a very brief way, I will also capture what is the market view in the third section. Okay, so the green line in the graph on the left, okay, is something that shows what is the price earnings ratio, and price earnings ratio sort of comes back and tells us like what is the valuation like. Okay, so if you see, interestingly, if we leave out that one blip around COVID, right, we are closer to levels of valuation which is around 2014 to 2016. Okay, so which basically means that the valuation of Indian companies relative to its past, right, is sort of reasonably good. We had seen a bit of an elevated valuation in this period from like 2017 to almost like 2020. Okay, now the good part is while the market moved up, right? So you'll see that after COVID market, which is the black line in the chart, okay, or even the it's colored as well. So that basically tells us how the Nifty had done, right? The index had done. So while the Nifty had continued to grow, interestingly, this line fell down. Okay, why is that? That has happened because the earnings growth has been very, very strong in India, which means that companies' earnings in India has been very strong, and which means that even while the market grew, the earnings grew far faster, which led to a fall in the valuation. So that's, to me, is one of the reasons why I'm extremely bullish for India in this decade. Okay, and that sort of is the highlight. The second point is because a lot of people are asking, do we think that market will fall? Yes, this is a chart I repeat because I think it's the same perspective that I want to give, that we are much more comfortable, if our P ratio is lower, okay, the market falls are lower. Okay, so if you see the P ratio when it was 21 and 22, the market falls only 30% or 15%, in that range. Okay, but when P ratios are higher, 28 and 29, etc., then we have seen very large falls. We have seen like even COVID, which is what my point has been. the COVID fall would have happened, I think, even if for some other reason, right? Because the valuations were very high and market fell 38%. But in other cases, when it was closer to 28, 29, right? Some of the cases have fallen almost like 60% as well. Okay, so that is something that sort of we keep in mind, and so that's what I think is a perspective that we are saying, that even if market falls, the lower sort of chart, shows that when P ranges are less than 22, a 3-year return is almost like 62%. And this is based on past historical data for since the inception of the Nifty. So that's something that we sort of keep in mind, that, in the long term, I think markets are likely to do well. And which is why one is suggesting that take advantage of the volatility and invest, when volatility is there. The other, of course, is, now these are complex charts of my PMS team sort of brings up, and we track some of these. Basically, what we're talking about, relative, valuations. And if you see, all of them are sort of below the average, right? So large caps are also lower. Interestingly, right now, even mid caps are lower, small caps are now becoming attractive. Okay, so that is something that, earlier we went a little conservative. Okay, and yeah, on mid and small caps, okay, and we had moved out. Now maybe we will start looking at getting back into some of the mid and small caps, especially small caps, and that is something, which I think will sort of drive markets also in the future. So I want to keep some bit of time for questions. So I said, let me try and finish by 11:45. Okay, so my summary is this. Okay, yes, the budget is a bit of a mixed bag. For many of us, it may not impact, okay, because the old regime may be better than the new regime if I have home loans, etc. Okay, and so it may not impact too many of us, but it definitely benefits the lower income slabs, lower slabs, as well as the super rich, which are above 5 crores. Okay, I did discuss that the new regime is beneficial for the others, if which are not in the low and not in the super rich. Okay, if one does not have a home loan. Okay, so that's the whole point of the new regime, because you don't have the deductions. Okay, if you don't use as much of deductions, then it makes better sense. And for somebody who doesn't use deductions at all, the new regime is definitely a thumping benefit. Okay, so but that's very unlikely for people above a certain scale, because you'll at least have your PPF, PF, and the ATC, and some of those, and many of us will also have our home loans. I did discuss that there has been negative impact of the budget for the guaranteed insurance plans, which has done very well, and some of our clients also have chosen to do that, because some of it is almost like guaranteeing you anywhere between 6 to 7%, 6.5 to 7% in terms of post-tax return in the long term and over almost like 35 years. Now, why we like it is because of also the tenure. Okay, because we believe as we progress in terms of time, one believes that interest rates in India will come down significantly. And even in a country like China, it's sort of, we've seen below 3% and stuff like that. So that is something that one believes will come in the long term. And, something like this is good to have. And so if you are able to, and, you are possibly, below, say, 50 years or so, then that's something, or even maybe 52, 53, I think then that's something which you should, definitely evaluate, because after April, then you may not have an opportunity there. The budget is a growth-oriented one. Okay, like one mentioned, a lot of infrastructure spending, of course, little bit of a rural angle to it. Keeping in mind we are next year is going to be election year. Okay, so that is something there also from a social focus standpoint, even beyond the rural side. Like I said, despite the social focus and wanting to give out some freebies in 1 year prior to elections, okay, they have made the government has maintained fiscal prudence, and I think that's the good part, and I think that's to me, that's a highlight, and that's something which is very, very positive. And in summary, just at an overall, on your portfolio, one believes that the budget is positive and the long-term impact will be reasonably good on your portfolio. I think that's all I had from my side. Okay, so Sanjay, we can open for questions. Please do share your questions, and one will be happy to answer.
Thank you, sir. I would like to request all the participants to write your questions if you have it to us. We already have around 700 questions. I will read it out one by one. The first question is, wanted to understand the capital gain changes made better, also the changes in the LRS.
Yeah, so the capital gain changes actually, there's nothing much out there. Okay, the only thing is that above 10 crores, right, that reinvestment of capital gains, is capped. So that is something which is not there, but capital gains this time has not been touched, by the finance minister.
Thank you, sir. The next question is, how do we make a decision for old and new regime? Any short working group?
Yeah, so you can also share it with us and we can come back to you. But broadly, like I said, if you have your home loan, okay, and you're taking advantage of some of the others like ATC. If you have your home loan, you also end up finishing your ATC as well. Okay, and you're using your NPS and all of that, then in most cases you may find that the old regime sort of does better. Okay, but I think as a simple one, if you don't have a home loan, then you may sort of end up finding that the new regime is better. And we can always compute it for you and just revalidate it for you if you want. Yeah.
Thank you, sir. The next question is employer contribution to NPS is considered a deduction in new tax regime?
No, typically the employee contribution is considered as a sort of a deduction. Okay, so it is not the employer side here.
Thank you, sir. The next question is education loan interest can be claimed in old tax regime? Any change in it?
Sorry, can you repeat?
Is education loan interest can be claimed in old tax regime? Any change in it?
Yes, so all of those continue. Okay, there's no change in the old tax regime deductions because not too many of them have been taken away. So you would have the benefit of that.
So the next question is, if I invest now in PMS in 3 to 5 years, how much roughly I would get a return considering the market scenario? It's something.
Yeah, so that is crystal ball gazing. Okay, and typically what I like to be conservative in projecting. Okay, so you will find that if you have, say, a multi-cap type of portfolio, I think in the long-term average is say 15%. If you look at some mid and small caps may go to closer to 18%. Okay, so if you have a large cap, maybe 12 to 15. So that's, I think, a little bit of a broad one. Of course, there are periods when large cap will do better, mid caps do better, and small caps. Okay, and they have the cycle between all of them. So, but I would think that in this period of time, I won't be surprised if we see higher than the average. Okay, so because one thinks that, so if you go back and see even from the standpoint of data, right? If you looked at for whenever the P ratio is below 22, you have almost like a 3-year return of 63%, which is almost like a 20% plus per annum. Okay, so you may have those good periods of time. Okay, but I think it's also important to see how you can manage risk in that period, those periods, because you may have volatility in between. Okay, so when you see 60%, say a 3-year return, okay, that doesn't mean that there wouldn't have been volatility, and you may have at times not felt like investing out there, right? And even now, I'm just giving an example. The sentiment will be so bad. Suddenly, there's this thing about Adani. There's a lot of bad news. There's every day some news of the item or the other will come. And you may find that you may not feel like investing, and you really feel, yeah, it may go down a little further. Okay, and that's how markets are. But the fact is, right now, after the market has fallen a bit, it's far safer than what it was before. but it's difficult to actually do that in action. Okay, so I'm saying take advantage of market falls and especially, in fact, I think the more you don't feel like investing, okay, those are periods when you should put more money. Okay, so I think, like I said, longer than better than long-term averages. Hopefully, as per past data, 20% plus one hopes.
Thank you. The next question is, any insights on inflation in near term?
Yes, so I think in the near term, I think inflation will come off a little bit because even globally as well, it had really spiked and we saw 10% and stuff. And you may slowly start seeing the base effect, which means that when it was 10%, the inflation was very high and then it comes off. Your base will be high, so your increase will be low. Right. So I think there will be a little bit of a base effect that you may see this year. So inflation hopefully should stabilize and stuff. But I'm just still waiting for whether we see further global market volatility. Okay, even though right now in the short term, when we're seeing that even global markets, including the US, are beginning to show positive signs.
Thank you, sir. The next question is NPS better option in new tax regime for business people?
Sorry, I'm not able to hear you well. Is it NPS you said?
Better option in new tax regime for business people?
I don't think NPS is there in the new tax regime. Can confirm.
Thank you, sir. The next question is, you mentioned that global growth has returned, but we hear about recession. So how does this affect us?
Yeah, so and most of the time that's always the dilemma that we all have, right? There are things which will be really negative, there are things which will be positive and stuff like that. And like I just now also explained, at periods when you feel like or are good for you to invest, okay, the news will be the worst or news will be bad. So if I go by that standard, and being a contrarian myself, okay, and that is sort of reasonably worked for us. Okay, it makes sense to actually invest when people are talking about global recession, etc. Our view has been a little negative on, especially on the US. Okay, and the reason for that, the US has seen almost like a 12, 13-year bull run. Okay, which sort of up to a couple of years back, right? So it has been a very, very long positive growth period for the US economy, and history has shown us wherever an economy does well for and is the star of the decade, you'll probably find that for the next 2 decades almost, they underperform. So one has been a little negative on global markets. So for us, it has not been a surprise. Okay, the only thing is, while that volatility happens, while the global volatility happens, everybody falls. But subsequently from that, the new leaders emerge. Right. So last decade we had the decade of China, which did extremely well. China is now down for the second decade. Right. So similarly, US became the leader of that decade. We'll probably see sort of US do poorly. So I think it can happen that way, that the dynamics change. For India, the previous decade actually was reasonably negative. Okay, because we saw a decade of deleveraging. Okay, so which means that if you look at it, if banks etc. want to reduce the loans they give to people, even the borrowers want to reduce loans because they are under severe pressure. So we saw that in the previous decade, there were a lot of NPA issues. If you remember, there were a lot of defaults that happened from AAA rated companies, etc. So there was a lot of cleanup that happened. Now something like that will possibly happen in the US, etc., because they did very well in this decade. So excesses happen, and you'll probably start seeing some bit of pullback, some bit of defaults. Okay, and their banks, we believe, could be under pressure as we go forward. Of course, these are not really short-term ones. Okay, but we're talking about almost like long-term, 2 decades, right? So that's the point. And yes, in this, while studying, cycles and multi-decades, how countries move, etc., one believes India will do well also from that cycle. Okay, so this is why I'm saying that yes, it's possible that India may lead while say the US may do badly. It's like what happened with China and the US, right? So China did very badly in the last decade, and the US did very well, right? So those are things which not abnormal, not unusual to see that some countries do better and some countries don't at some period of time. So that's a long explanation to you, okay, for having a different view on India versus let's say global.
Thank you, sir. The next question is, I'm planning to buy a house worth of 2 CR. Would this budget cost me more or less? So how it will impact the decision?
Yeah, so first of all, I think from inflation coming down, that's a good thing for you. Okay, less pressure. Hopefully, you'll get some better stuff. Yes, on the house per se, there's some benefits for building materials and some of those which may percolate down, but I don't think much will happen. Okay, so I don't see any benefit you'll get or any negative that you'll have. At least the inflation that we are seeing in building materials and all of that, even just 2 years back was extremely high and heavy. Okay, now the good part is that is not there. So, so the real estate companies may not be under great pressure to give you a better deal. Okay, so I think that's a good part of it. But I think from a standpoint of it's about if you're financing it by loan, okay, what's the interest rate? On the house side value, maybe you can get a reasonably good deal. Okay, so on the budget, I don't think you get much apart from some benefits to the building material sector, which hopefully has an indirect positive impact for you.
Thank you, sir. The next question is, any benefit subsidy in the budget 2023 for electric vehicle or green energy?
Yeah, I'll have to come back to you on that.
The next question is it good idea to invest now in global stocks or is in India better?
I just enumerated my view on global versus India, and I think India will do far better. Yes, at times it's like in recent days. Say, I'll give you an example. A customer came back to me saying that that he's a NRI. He came back saying, "Should I buy Adani stocks? Okay, don't you think it'll do very well?" Okay, and of course, this was in the first 2 days itself. Okay, so I just told them that, see, my view is sometimes we search for bargains. Okay, and the issue with bargains is if they do, they either will do very well or they'll do very bad, both. Okay, and my experience again is that most of the time it's like sometimes you get it right, sometimes you get it wrong. In the end, there's no incremental return that you ever get in that. You only see a whole lot of ups and downs, and you feel okay, good or bad, or sad or happy. So I would rather look at disciplined long-term investing, looking at stocks which have better earnings growth, lower valuations, and all of them. So I would still think that the perspective of saying, yeah, maybe Nasdaq stocks have fallen, say 30, some stocks have fallen 60% as well. Okay, is it a good stock to buy? Typically, I would avoid some of those because I think it's a cycle turning. Yes, if you're a trader, then come in and get out. It may work well for you. Okay, but I think for a long-term investor, I would still go for stability long term, not search for bargains in countries like the USA, which have fallen down, because I continue to have a negative view for a longer period of time. Of course, short term, because it's fallen down too much, okay, there will be some pullback, there will be some growth coming back in. Okay, but I think the pain and fundamental pain is likely to be there for a longer period of time. So I think at this point, we have done global investments. In the past, we've also looked at it. We were careful not to do too much of, actually, we kept the US out of our radar for investing while we invested in global stocks. We tried to search for funds which are actually global and not just US. Okay, so that we look at stocks, I mean, beyond the US. So that has sort of worked well for us. And being in a Bangalore technology hub, etc. We had a negative view on tech stocks. Okay, many customers maybe did not understand why. Okay, now history has it, and for me it was just that the cycle has played out too much. Okay, and I don't think technology will become irrelevant. It will always become more and more relevant. But at some point of time, there is inflection that happens, and the companies underlying either cannot just maintain that growth. Okay, and market is pricing a higher growth. Okay, and those may be long term, and it may not come back to a high growth again because already there's enough and more of penetration that will already happen. So I think that from that standpoint, don't go bargain hunting on technology stocks unless you're a trader and you know when to get out as well. Okay. On the other hand, I think India is definitely a long term. Valuations are much lower than the past. Yes, people do say that today India is, and when you compare with global countries, our valuations may be elevated versus other countries. Okay, but that also is because you're not finding too many places which are seeing this type of growth that India is seeing and the demographics that we are seeing. So whenever market sees that quality, it always gives you a higher price. So that is my view. Continue with domestic versus global.
Thank you, sir. I think we are running out of time. If you allow me, we can take one more question.
Yeah, we can take one or two more questions.
Yeah. So the next question is, by opting new tax regime in next financial year, is it better idea to stop investing in NPS and divert that fund to FlexiCap open-ended fund, mutual fund?
Yeah, so everything has its own benefits out there. Okay, so you may just find that in the longer term, if you are if you're using new tax regime, definitely NPS will not give you a tax benefit. Okay, but NPS is a low cost one. I think it's not very comparable to say, okay, because let's say a FlexiCap type of PMS portfolio, typically infusion will be larger. It's not going to be just 50,000 rupees, right? So maybe from a diversification standpoint, I would still continue to sort of, even if I lower the contribution to NPS, I may still continue it because I don't know, 2 years from now what will happen. The government policy is always, one can never say. I would not close it out, but keep it open, maybe smaller contributions. And yes, from a open-ended schemes are always better when there are no lock-in if say you're not locking it from tax purposes, etc. I think Sanjay, there was a question also that I'm seeing on TCS and LRS. Okay, so that is okay. That was saying that thank you for explaining.
Yeah.
Okay, they were comments, they were not questions. Okay, continue.
Yes, sir.
Last question.
So the last question is, if the interest rate has reached to peak, will it increase further?
No, I think that in the short term, interest rates will stabilize, maybe come back a little, but I don't know if it's all over yet. Okay, because I think if I look at developed economies like the US, etc., the interest rates are far lower than the inflation right now. Okay, so for India, of course, it's a much better situation because we are used to higher inflation in the past, and our interest rates also are sort of higher there. So that is something which is there, but in the medium term, I don't expect inflation in interest rates to go up. Even inflation, I think, because of base effect, will sort of stabilize a little bit over the next quarter or two. So I would be sort of neutral on interest rates. Yeah.